Hello, and welcome back to Reflections on Investing with the Cornell Capital Group. At the end of this week, the Cornell Capital Group is going to be releasing its first industry report, which will focus on the valuation of the auto industry. And it will use two key concepts. And that's what I'd like to explain to you today. The two concepts are, first, invested capital. And let me write that down here. Invested capital is basically the amount of money that investors have given a company to invest. And it's to a very high degree of approximation. That equals two things. The book value of equity, which I'll call book equity. You'll see that on the balance sheet, plus the book debt. And that's invested capital, the amount that investors have given the company to invest. That's compared to what is called the enterprise value. The enterprise value starts with the invested capital, but then it adds on any value the company has created. And it also has two basic components. It's the market equity, which is often called the market cap, plus the market debt. So I'm going to abbreviate, I'm going to abbreviate this IC. I'm going to abbreviate this EV. And a critical ratio for a company or an industry is the EV to IC ratio. How much value did the company create for every dollar it was given by investors? And let me do that calculation for two companies in the auto industry and then explain what it means. So if we go here to a new page, start with General Motors. So I want to get the EV to IC ratio. Well, for General Motors, the enterprise value currently is 196.4, whereas the invested capital is 160.4. And that ratio equals 1.23. So for every dollar that has been put into General Motors by investors, the company has taken that dollar and turned it into $1.25. How do they do that? The way they do that is they earn a rate of return on the dollars they have in excess of what's called the market cost of capital, what it costs, what investors require to give them the money in the first place. So GM has been relatively successful in doing that. Its ratio is 1.23. Now, that's nothing compared to someone like Apple. Apple's ratio is on the order of 15. But that's because Apple has a very predominant position in its market and makes products that no one else can match. Well, let's look at another member of the auto industry, and that's Tesla. Tesla currently has an enterprise value of, this is a couple days old. Tesla's enterprise value moves around a lot, of $1,163 billion, or 1.16 trillion. And the invested capital is 37.8. So the ratio is about 33.4. Approximately 25 times what it is for General Motors. And that's saying that for every dollar that has been put into Tesla by investors, the company has turned that into $33.44. How could this be? The market seems to say that General Motors earns just a tad bit over their cost of capital on investments. But Tesla is expected to earn far more than its cost of capital. We'll delve into these when we release the industry report. But for any company you're looking at and thinking of investing, one thing I urge you to calculate right off the bat is the enterprise value to invested capital ratio. This has been Reflections on Investing with the Cornell Capital Group.